Good morning, everyone, and welcome. I'm Laura Casera, Chief Marketing and Business Development Officer at Cohen and Gresser, and I'll be the moderator of today's webinar. We are pleased to have you join us, and just as pleased to have three highly experienced advisors with us this morning who are at the forefront of law firm strategy, transactions, and growth. Larry Gresser is a co-founder and the global managing partner of Cohen and Gresser, and a trusted advisor to businesses, boards, and executives on complex strategic matters, transactions, and high-stakes legal issues. Dan Mathias is our managing partner of Cohen and Gresser's London office, whose practice focuses on sophisticated corporate transactions, including private equity investments, mergers and acquisitions, and growth-oriented deals. And John Fitzgerald is co-leader of the law firm industry practice at Citrin Cooperman, where he advises law firms on financial strategy, operations, and long-term business planning. And additionally, he's also the managing partner of Citrin Cooperman's Long Island locations. Together, they bring a practical and informed perspective on one of the most significant developments currently reshaping the legal industry today. This morning's discussion will explore the growing interest of private equity in law firms and the key strategic considerations for firms evaluating whether and how to engage. The first question is for all of you. What are you seeing that is driving the current trend for private equity investment in law firms? Larry, let's start with you.
Thanks, Laura, and thanks for the introduction. From the investor side, law is really the biggest sector that has so far largely been untapped by the modern financial system, late capitalism, call it what you will. I've said that it's the last unplucked turkey out there after private equity and other financialization sectors have rolled up. The medical sector, consulting, accounting, and many smaller parts of the economy. So I think the investor community looks at law and sees stable cash flows, significant margins, growing pricing power, and thinks, we can help rationalize that. From the firm side, I think the three big drivers are an increasing need, not just for capital, but for long-term capital, for slow capital, patient capital, in a way that's hard to reconcile with the classic law firm strategy of distributing cash and essentially not quite winding up every year. Firms are keeping more and more cash in-house, but nowhere near the amounts of capital that I think firms are starting to realize they're going to need in the new economy. A second reason is a real concern about retention and acquisition of talent. Again, law is weird, and we'll talk about that in a second, but the way law firms typically work, it's very difficult to keep the partners that you want to keep who have strong client relationships, except by giving them ever-increasing amounts of cash, and that has some knock-on effects that have not been great, and I think it's increasingly a concern on the firm side. And the third reason is I think there's the dawning realization that they have an asset here, the equity in their law firms that has been largely untapped, again, for reasons we'll talk about in a second. So the advent of outside investment, largely private equity investment to start, but it may not always be that, but outside investment in law firms creates the possibility of unlocking the value in law firm equity. Now, here's what I mean. If you take a step back, the legal sector is just plain weird. It's an all-cash economy. No firms have real boards of directors. They certainly don't have outside directors on their boards. Their equity, law firm equity, traditional law firm equity is really more like phantom equity in the sense that it gives you a claim on cash flow at best, claim on earnings, but it doesn't serve as a permanent store of value. You tend, at the end of your time with a firm, you tend to give it back to the firm and get the capital that you put in with little return or no return, regardless of whether the firm has grown and whether the equity value, if it were a normal business, whether the equity value would have increased. It's just weird. It's 100% employee owned. That's not a structure that you see in other large companies. Um, why did law land evolve like this? A lawyer would talk about ethical rules and the history of the profession and magic and how it's very different. As an elderly lapsed Marxist, I would say there are structural reasons for it. And I think maybe the better question is, why has it lasted so long? And I think the structural reasons are things like, historically, the legal sector has been capital light. You need a website in the modern world. You need some technology. You need some office space. Your employees and your attorneys tend to be variable expenses, not fixed expenses. It just doesn't require a lot of capital. And to the extent that you're taking on that you need outside money, you can get it in the form of bank loans for relatively low interest. And you haven't needed that much. For many years before the GFC, firms would run on their credit lines and make it all up by the end of the year, and it was all fine. Think Yertle the turtle at the beginning of the book. The turtles were happy. There was plenty to eat. The other cultural reasons why Lawland has persisted in being what I call weird, relatively low turnover at the partner level historically, low concentration by historical standards, by the standards of other businesses. It's a very fragmented industry. Major clients frequently had institutional relationships with the firms themselves. And then things changed. I date it to the GFC. I date it to the global financial crisis. I think a number of things happened after that, 2008, 2009 near-death experience for the economy. For many clients, everything was up for grabs. If they survived, they started taking a hard look at their counsel relationships, and it became possible to acquire clients that historically you'd have no shot at whatsoever, speaking from the law firm perspective. There was already a lateral market for partners. I think it increased. I think the elite firms, the elite law firms after the GFC and through the GFC, adopted a strategy that many of us initially found confusing. They kept raising their rates, which had the effect of differentiating themselves, differentiating the 15 or 20 firms in the top 10 from the rest of the Am Law 100 forever and ever. And then, in addition to the conflicts, the clients being up for grabs, and the increasing lateral market for partner meant that partners were increasingly up for grabs. The third thing that has really changed is the increasing need for technology, and that's both defensive and offensive. To compete at the highest level, firms are going to increasingly need to spend more and more money on legal technology in general, and AI in particular. You will have seen the article about a week ago saying Kirkland is investing $500 million in AI technology. I'm not here to say how real that is or whether that's money that's well spent, but I am going to say that firms feel increasing pressure to make investments in technology. That's a long-term investment. That doesn't really fit well with a cash economy, which is what Lawland has historically had. So now, instead of capital light and largely stable sector, you have a capital intensive sector with a real retention issue, because you will have seen that partners increasingly are moving from firm A to firm B, and sometimes back then to firm A, with ever increasing pay packages. And given that it's a largely cash economy, that's extraordinarily expensive. Herb Stein, former chair of the Council of Economic Advisors, famously said, when something can't go on forever, it will stop. I think firms are increasingly realizing that and are much more interested in finding a new retention strategy, which real equity can provide, and building up balance sheets that are commensurate with the actual size of their enterprise, because they need the capital.
Fantastic. Thank you. Thank you for that. Dan, is there, from your perspective in your seat, anything you want to add to that?
Yeah, I think following on from Larry's summary, from a regulatory position, the UK was one of the first adopters of non-lawyer ownership to be permitted. That's been over a decade now. It takes some time. It takes some time for the market to recognize that. It takes time for the market to get comfortable with what is essentially a complex people business, which is what law firm is. Um, and although in the UK it's been over a decade, we're only now starting to see a couple of examples where investors have invested into the industry and we've started to see a couple of exits as well. So that it takes a bit of time to build that conviction amongst investors. I think some of the points that Larry mentioned from investors' perspective is, they may have had success at other sort of professional service businesses, and so they therefore, rightly or wrongly, see law in the same opportunity. And now that certainly in the UK, there's a regulatory change in the permission to own law firms. Now you're seeing in the US this evolving structure with the MSO, which we'll touch upon shortly. But through the comfort of other transactions in other professional service businesses, that's helped people to understand it better. Law is also a classic example of has some of the ingredients that an investor likes, i.e., it's fragmented, it's a regulated business, and therefore barriers to entry. And although that it is a profession, there is also, I think, a recognition that for a number of law firms, there's genuine opportunity for further professionalization, if that's even a word, to bring further operational strength to a business. And like many generic questions, there's not just one reason. I think there's a multitude of factors as to why it's increasingly becoming more and more mainstream. I think it's the classic analogy is, the 10-year overnight success. And in the same vein, people have been talking about something for a while, something's been possible for a while, and it takes a certain tipping point for something to become all of a sudden much more mainstream. We're still at that tipping point. We're still at that early stage, and I think there's lots more to come in the years to come. But I think that a combination of factors as to why, in particular, now we're seeing more and more activity in this sector.
So what Dan is gently alluding to, very kindly alluding to, is the fact that some of us have been boring our friends with stories about how this was coming for well over a decade.
If you say the story long enough, it might come true. So
Thank you both. John, I think if there's, anything that you want to
Yeah,
cap that off with, and then potentially maybe go into starting to talk a little bit around the proposed MSO model versus tradition. So John, I'll
Sure.
turn to you.
I think the only thing I would add to the comments that Larry made and Dan is really just the attraction for younger partners as well as non-partners at a law firm. And Larry alluded to this, but the PE-backed model really offers potential for multiple capital events. So over a course of someone's career, this could be attractive to younger partners who are not just concerned about, annual compensation, but also building long-term wealth that I think the PE model could potentially add to that. So, that's one other thing I would just stress that I think as part of the retention model. As we get to the MSO structure, when we talk about the proposed managed service organization of the MSO model versus the traditional law firm structure, we're really trying to stress here is how we reconcile private equity investment with the regulatory constraints. And there's a few considerations. And I think, as many people on this call obviously know, most law firms in most jurisdictions cannot have non-law firm owners. So what the MSO really does is it sits alongside the law firm and is owned in whole or part potentially by the private equity investor. The MSO is the vehicle that provides non-legal services such as technology, marketing, HR, finance, infrastructure. It could potentially own the name of the law firm and lease it back to the attorney firm. And the actual law firm remains lawyer owned and controlled, preserving the compliance with rules around the practice of law. So here we kind of put up a structure of what that would look like, whereby the equity partners still own the law firm, but the institutional investors, along with the law firm partners, own the MSO. And those institutional investors just don't have to be lawyers anymore. It could be a private equity company. It could also be CFOs, CEOs of the law firm that are not attorneys. So really the core tension is, is the traditional law firms are built on independence, they're built on partner ownership and governance, and as well as the ethical obligations that prioritize, client interest above all. The MSO model introduces this external capital, a return on your investment, as well as operational centralization. So, I think the challenge becomes, how do you introduce this institutional capital without undermining the core principles of how a law firm is built and how the legal practice has traditionally been built over time? So I think there's more to come here in terms of how this evolves. But right now, what we're seeing is that this MSO structure is the primary structure of how law firms are being invested by private equity.
Thanks, John. Larry, do you have any comments on this, or maybe we can get into some of the pros and
Just very quickly,
cons on the next slide?
Yeah, just very quickly. John's description is very clear, and he's exactly right. Even a year ago, there was a lot of discussion about how outside investment would come into the legal sector. And I think the market has essentially settled on this MSO structure. There were a couple states that created sandboxes. Arizona did it. DC has always effectively had it. But the larger firms realized that taking full advantage of those structures was going to be tricky because there were other states that didn't allow it. If you practiced across state lines, that was going to be difficult. So it's the MSO structure that seems to have carried the day. There have been a number of deals in the sector. A number of law firms have taken in outside money at this point, mostly in the personal injury space. And my understanding is that they have all used some variant of the MSO structure.
One final comment from me on that MSO structure is the potential to, if you want to future-proof the law firm, in the future with tech-enabled services, that increasingly senior non-attorneys will become an increasingly important element of that business. And so an opportunity for non-attorneys to gain ownership in that business as well is attractive proposition to some.
No, that's a great point. That is actually a great point because we don't know exactly what the new world is going to look like. It's possible that the MSO, in addition to being essentially a captive, either a captive of the law firm or the law firm a captive of the MSO, the MSO can do other things as well. The MSO can develop technology on its own, potentially provide services to more than one law firm, and potentially actually develop products that could be sold to more than one law firm. We just don't know how it will happen, but it will create a lot more flexibility, introduce a lot more flexibility into the sector in a way that could be great.
Can we touch on just a comparison though of just, PE versus remaining independent?
Yeah. So I think, obviously the pros of private equity, I think we've gone over a lot of this, is the access to capital for greater financial independence, obviously monetizing for partners. Like Larry had mentioned, you build a firm your whole life, and then when you retire, you don't really get a return on that equity that you've built up over the past 20, 30, 40 years. More professionalized management, where now you're going to be working with a board, most likely, maybe going out and professionalizing your C-suite more, and coming up with different management strategies than you have in the past as a law firm. Obviously, the consolidation and platform strategies, and consolidation and platform strategies take a lot of time, and I think where people have to realize here, like the whole integration model, and going from a firm that was building organically to a more of an inorganic growth platform is going to be a very strenuous process, and it's going to put a lot of strain on your internal processes and your culture. So it's going to take some special people to be able to lead a firm through that, and potentially have a competitive edge where, where I kind of look at that is that if you're out there looking to be able to grow inorganically and you have an ability to incentivize people to join your firm, not only financially, but also because of the pattern that you're on, or the strategic function that you're going for, it becomes more attractive for those to potentially join your firm, as opposed to maybe another firm that doesn't have a professional investor. And obviously, remaining independent, I think autonomy becomes the number one answer there, right? Your partners retain control. There's less short-term pressure about an exit strategy where, we all know private equity comes in, they're not looking to be your partner for 20 years. There's going to be an exit horizon, and that exit horizon is going to be built on growth. We mentioned before the culture. And obviously, with this MSO model, as Larry mentioned, this hasn't been really tested so much. And I think there's going to be potential challenges here. So the pros of remaining independent is that the regulatory and ethical issues stay at bay. And I think there's no execution risk. And as well as, you're not disrupting the way your partners are paid. So I think that kind of sums up where we stand on the pros and cons, and I'm sure this will develop as time goes on.
Yeah, absolutely. Thank you.
I know, I was just going to add, I think that pros and cons is a good segue into the majority versus minority, which I think is the next point. So, I mean, there's many different flavors when we're talking about majority and minority. 51-49 is technically a majority, 60-40, there's many different flavors. But essentially, the key differences, and some of those are touching on the pros and cons that we just discussed, is control, right, in terms of future trajectory of the business, higher liquidity event at the initial transaction, but potentially much more change to that business, as opposed to a minority transaction, where a partner may, or the founders may want to retain more control, have a more gradual change to that firm, but with the understanding that potentially a slower change in trajectory. I think the most important point for anyone considering it is to have a clear understanding as to what they're trying to achieve, what is the goal of this transaction, and different people will come at it from different perspectives, to the point of a succession planning, and more focus on a high liquidity at the outset, versus there might be a specific rationale for what the capital is going to be used for. It might be for a specific technological program, specific team lifts, some M&A. And so having a strong understanding of what exactly we're trying to achieve here strategically then builds into the majority versus minority. There are also constraints from the investor's perspective, right? Some of them may be new to this industry and with the regulatory position, some reservation, and so therefore may be more inclined to want to dip their toes in and more inclined to do a minority transaction. Others may be very comfortable with it and very keen on that control position, because there's obviously much less ability to influence the less the stakeholder is. And so there's multiple factors, but I think having a good understanding of what exactly everyone's trying to achieve helps into those conversations. Larry, I don't know if you wanted to add anything.
Yes, I'll be slightly controversial. I think the whole majority versus minority thing is a bit of a red herring for the following reason. We're talking about who owns a minority interest or a majority interest in the MSO. It's much more important, I think, to be very clear as to control rights, information rights vis-a-vis the MSO and the law firm. You can have a scenario where the outside investor owns, call it 60% of the MSO, but has effectively no control rights whatsoever over the law firm, and relatively modest information rights. and where the incentives are aligned in a way that makes the outside investor, albeit a majority owner of the MSO, still very much a passive investor in the whole enterprise. I think that question, the relationship between the MSO and the law firm, is much more important and has to get a lot more focused attention if you're interested in this structure than the question of whether it's a minority deal or a majority deal. That will depend a little bit on what you're going to use the money for and all the things that Dan mentioned.
I mean, there's also, of course, a variety of capital out there and a variety of investment firms with different appetite, different timeframes. So, for instance, if a family office, they may have a different time frame than certain firms. Certain firms may have, and in terms of their ability with debt and how much they can fund this themselves. So there's not just a one size fit all, right? There's a multitude of PE firms out there, multitude of investment capital out there that could impact this structure as well.
Yeah, we'll talk about the different flavors of outside investment in a few minutes. It's one of Laura's questions, I think, but I completely agree with that. I think the type of investor you partner with is more important than the question of whether or not the investor is getting 51%, 40%, or some other percent of the MSO.
Yeah. Shift gears a little bit for now and ask, I just want to talk about when it comes to preparing your firm to go down this road. There's a lot of business processes and issues to consider, a lot of planning involved to ensure you stay ahead of the game. Can we maybe spend a couple minutes and just talk about what some of these key areas are? John, maybe we can begin with some of the financial areas.
Sure.
Rather. Thanks.
Yeah, sure. Thanks, Laura. Absolutely. And when you go down a path of this MSO structure with private equity, obviously the financial foundation is going to be more disciplined and transparent than maybe what traditional law firms are used to. And I think you kind of look at it in a couple areas, like the financial reporting and transparency. Most law firms today are usually cash basis firms, like Mary mentioned earlier. Obviously, when you go into a more of investor ready, you're going to be GAAP level financials, which will take more in audit ready financials as well, which many firms are not used to. I think being more consistent and having clean historical information with normalization of partner comp is important. Being able to present key performance indicators such as realization, utilization, matter level profitability, revenue per lawyer, by different sectors, and really trying to understand how your business is profitable and where the margins come from. And I think partner compensation and economics becomes very important. In many firms, partner comp is effectively what the profits left over after they pay everybody else. And real, financial investors are going to want to distinguish between what's really market-based compensation for that role versus true profit. So there needs to be an alignment of incentives between, the distribution mindset of long-term equity growth to create this model. And I think really understanding profitability and cost structure. Many firms don't fully understand which practices or clients or matters are truly profitable once all the fully loaded costs are considered. So really understanding the fixed and variable costs, understanding attorney leverage and overhead technology spend all become opportunities for margin improvement. And PE will focus heavily on ways they can expand margin improvement post-investment. And I think many firms often carry significant work in progress and accounts receivable. So improving that billing velocity, converting that work in process and accounts receivable into cash in a more efficient manner will be more of an impetus and more of a cash flow predictability model, I guess. And then last, I would just think about is like really having a strategic plan around technology and capital investment, where really understanding where the needs are and having it kind of laid out over a longer period of time, as opposed to many times now law firms are not really working on a strategic plan over 3 years or 4 years. It's really more year to year as to what they need, and really looking at that and getting to that ROI methodology of understanding that every investment they make should have a stated return, and why they're making that investment is to grow the firm and to have more value.
Thank you. Dan, any comments on your side?
Yeah, sure. I mean, to follow from John, obviously, financial planning is critical. CFO being heavily involved is critical. Quality of earnings, etc. I think a much more basic comment from myself would be practical. Who's the team? Who's the core team? Who's going to be running this process? The people I know, and not just on this sector, but in a number of sectors when it's the first time founders and others are doing a transaction with a private equity firm or an investor. Oftentimes people underestimate, the commitment involved. It's two jobs, possibly three, if you're already doing internal management in your firm, as well as running your own practice, as well as running a process. And so there's a couple of ways of doing it. You can dedicate a core team to be running that process, whether it be divvying up certain responsibilities on the entire process, or whether it be a tag team situation, depending on the underlying business of the firm as well. And so from a practical perspective, as well as key point, of course, financials, of course, strategic, understanding what we're doing, it's then who's the core team who's going to be running this process for us, and how do we allocate that amongst ourselves whilst having to run a successful business day to day.
Okay, that's an excellent point. Larry, anything to round it out?
Yeah, just quickly. I think every lawyer on this webinar, hearing John's list of things that you have to do to get ready, I think their heads exploded. And I think most non-lawyers listened to the list and thought, wait, you're telling me these multi-million or billion-dollar enterprises aren't doing this already? Spoiler alert, they're not. John stole one of my lines. My number one recommendation was going to be do a strategic plan. We did it a few years ago. It was extremely helpful. It really forced us to wrestle with who we are, who we wanted to be, and what the metrics would be for success along all dimensions. Some of the fluffy stuff, but also some of the numerical stuff, some of the real performance stuff. My other strong recommendation, and it's consistent, it sits alongside with what both John and Dan were saying, is we mounted an initiative about 4 years ago to start to professionalize our business functions. Lawyers always think they can do everything better than anyone else can do anything. It turns out not to be true. Who knew? But you need to rest it. You need to rest every function that can be wrested from their cold, dead hands and get it into the hands of qualified business professionals. We have a number of C-suite executives at the firm now. It's been great. One of them is on this call. She's pretty good, turns out. Who knew? No, she's wonderful. She's absolutely wonderful. But we've got a great COO, CFO as well. We have a chief innovation officer who's one of the leading legal tech and AI figures in the world, who is helping us build the road before we buy the Ferrari of AI. Whatever your particular strategy is, put it in the hands of qualified business professionals. Let them run through John's list. It will be much less daunting for them than it would be for a lawyer trying to pretend to do it.
Thank you. Along the lines of kind of, setting up for success, when we think about going down this path and choosing, I think choosing the right private equity partner is critical for sustainable growth, for optimal culture, and just long-term. Can you discuss your view on the right strategy in making this decision? And Larry, I'll start with you and your thoughts.
Okay. I think it goes back to Dan's point, which was very, very good. You need to have a clear understanding of why you're interested in an MSO transaction, why you're interested in outside investment, what you would use the funds for, why it's necessary. There are lots and lots of benefits. There are some downsides. If you start with a clear strategy, you can then assemble a team of trusted advisors who will help you find the right capital provider for your actual strategy. And they do come in multiple flavors. It's already starting to shake out. Some of the largest PEs are interested in essentially doing a classic private equity strategy, acquiring a majority interest in the MSO for a very large firm, and then with stable cash flows, and then trying to optimize. That's sort of what I think of as the classic PE strategy. A number of smaller PE funds and some larger ones as well are interested in a different strategy, more of a classic VC strategy, where you make an investment in existing management, generally a minority investment, but as we discussed, it could be a majority investment because it's a majority investment in the MSO, not the law firm. And it's essentially a growth strategy. So those investors are trying to find firms that could serve as a platform for future roll-ups in their sector, or maybe there's a different growth strategy. I think there's a third category as well. I think there are some outside investors that may be okay with structuring the investment as equity, but what they're really thinking about it as a debt deal. Depending on what you want, depending on what your strategy is, that can be okay too. There's no wrong answer. The only except for an answer that creates misalignment between your expectations for a transaction and what the outside investor would be interested in doing.
Yeah, to follow up on that, I mean, if you're talking about doing a minority, you could ask, well, why not some debt, right? If it's a low capital, but I think the point is that it has to be an added value above capital, and so that also impacts who you want to partner with, because it is essentially a partnership, and there has to be alignment in the strategy, but potentially add value add from the investor, and that can come in different ways. It could be an investor that has success in other industries and thinks they can bring that to bear. It could be a existing client of the firm that could turbocharge and bring in more like-minded firms to that platform. So there could be a business rationale for it as well. Cultural fit is of course important, and it's like in every other partnership, every other business venture, a joint venture, is that cultural alignment, trust, and everyone understanding on the same page as to what they're trying to achieve.
Yeah, and the time horizon is critical. John mentioned it earlier. Most private equities are focused on exit. Dan mentioned family offices. There are large family offices that might be okay with acquiring and holding for a very long time an interest in a distribution or dividend producing asset like a law firm MSO. You just need to figure out what your ideal strategy is, what you could live with, and what the universe of potential capital providers looks like to try to find a match. You need advisors to do it. Don't do this on your own.
Yeah, and it may not be to the highest bidder, right? There might be other, there might be some uncertainty with some people. How long will they take? To John's comment earlier as to execution risk, and so certainty is the other factor that often brings to bear on these types of transactions when there are multiple potential parties involved.
Yeah, no, that's critically important. This is not, it's a market very much in flux. It has not settled on a particular structure yet. It's not commoditized at all. So it's not a question of just going out and selling your little MSO to the highest bidder. You have to be much more careful, much more discerning about who your partner's going to be.
Thank you, John. I guess John and Larry, when it comes to the allocation of MSO equity and other retention strategies, what are your thoughts about what should be top of mind?
Yeah, I think obviously when it comes to the allocation of really shifting from like a compensation mindset to a true ownership mindset. And I think who gets equity and why becomes a big stumbling block. And I think equity needs to be tied to value creation, not just title or seniority. And you want to be able to reward the top performers who are critical to the platform going forward, to make sure they see meaningful gains and participation. And I think, balancing the legacy partners versus the next generation is a challenge, right? So senior partners may be looking to monetize today, where younger partners may be looking for long-term upside. So the model needs to kind of consider, providing near-term liquidity for senior partners, but preserving future equity pools to monetize the next generation, as well as laterals and other talent that you bring in. So and part of it we mentioned earlier today was a retention incentive, right? So it can't just be a time-based vesting. Best structures, revolve around looking at performance-based and time-based on some of the equity hold periods. And I think there needs to be clarity around liquidity events. When and how people get paid, what's the second bite of the apple, what that really means in these types of transactions. And because, the first time someone sells a private equity, typically there's a cash and an equity component. That equity component is basically something that they're going to hold to the next turn. But as well, there's also a lot of profit-based units that are going to be able to be giving out to either employees, non-equity partners, or well as laterals that can really help grow the firm. It could help provide incentive to keep some of your key people there. And it could also be used as rewards going forward in lieu of compensation as years go on. So I think, it's very difficult in law firms to have strict non-competes and non-solicits because of it's not, the law does not allow for that. So you really need to understand how you can put these models in place to keep talent and incentivize growth for the long term. And I think it comes down to a level of making sure that there's some level of fairness and transparency in that process. It has to be understood. The employees and the partners, non-equity partners, need to feel that it was done fairly. And it wasn't just to a sellout of the senior partners, that was really a long-term growth opportunity for the firm.
I have a friend who's a senior executive at a major investment bank. Every year for the past 10 years, he threatens to retire. Every year for the past 10 years, he gets another slug of restricted stock units with a 5-year vesting. And he looks at the vesting schedule and thinks, all right, I won't retire. It's been going on for 10 years. He'll probably die there. Well, they'll throw him out. Even with the ethical constraints about non-competes for lawyers, a properly structured equity program at the margins will eliminate partners leaving, but it will reduce the crazy spiraling lateral partner movement that we've been seeing over the past 10 and particularly the past 5 years. It'll reduce it. It'll increase the costs of a partner moving. You'll have higher retention, more stability in the firm. It'll really actually help. My only other comment is I think the right outside investment partner can help you design an equity program that will work for your firm and help achieve the goals that you're trying to accomplish. This problem is like checkers. It has been solved in the outside economy. It's a new problem in the U.S. Law firm market because of the historical factors that we talked about earlier. But there is a lot of very smart knowledge on this issue in the possession of the best private equity funds, which are not always the biggest. But I think this is one to get some real help, not just from your outside advisors, but also from whichever capital provider you select as your partner.
We've also seen that if everyone's aligned with the incentive under the MSO and excited by those prospects, the ability to a departure, but unable to gain interest in another MSO, we think that would be enforceable. And so there are some novel ways of people thinking about that as we're going through this new structure as well.
Thank you. Sean, I'm going to put the spotlight on you for a little bit. As we look at kind of the broader the broader landscape of professional services firms who have been down this road before, as you. What are some of the kind of key lessons learned or key takeaways that you might give some insight on for us?
I think the key is that think of this as not really a transaction. It's really a transformation. Firms that succeed recognize early that this is not just a liquidity event. It requires a real shift to operating like a real business, building a scalable infrastructure, committing to long-term value creation. And it's not just taking chips off the table or de-risking your investment. It's really, how do we grow our firm post-transaction? I think one of the things that has to evolve quickly is governance, right? Traditional partnerships probably have been too slow and too consensus driven in order to move. I think you need to move faster in this environment. You have to empower professional management. You have to separate the ownership from just the operational leadership and creating clear decision rights. Without that shift, the execution will become inconsistent and the value creation stalls, I think. Cultural alignment, is key, right? Firms that are culturally aligned are the ones that are going to be successful. And introducing the PE brings that increased transparency, brings that financial clarity, performance accountability. But those lessons will not be successful unless the culture is there and the partners buy in to this new way of working. And people have to realize that that structure is going to be really important in order to grow. Incentives drive behavior, right? So the firms that perform the best get alignment from their partners, their investors, their management team. Where there's misalignment, especially around equity or compensation, I think you tend to see more friction and more key of certain loss of key partners. So I think that behavior and that culture it cannot be understated. And I think just closing the deal is a starting point. Closing a deal, as many lawyers know, is difficult, but that's just the real starting point in this. And then the real upside becomes from embracing margin improvement, embracing the cross-selling as you have the ability to use some of that capital that you have now to deploy it for real strategic partnerships with other firms or other providers that can help fuel your growth.
Mm-hmm.
That's a perfect opportunity to increase your margins and really looking at operational efficiencies. So, I think those are the key things. And I still feel like, to Larry's point, talent risk doesn't go away. Retention isn't an automatic, but I think, key rainmakers will continue to leave if expectations aren't met. But I think if we do this the right way, to Larry's point earlier, to his friend that's been trying to retire, there will be more retention at those levels. And then you get into like scale and technology become the differentiators, right? How do we scale our firm? How do we utilize technology? And PE-backed firms that win tend to have a big investment in technology, a big platform that's standardized and scalable, and they're not afraid to invest in it, where traditionally law firms have always been a little nervous about investing in technology. It's more of a dip the toe in the water. Going forward, there's going to be more of a dive in. We are going to use technology in order to grow. And I think the quality of their revenue matters, right? Really looking for recurring, predictable work, institutional client relationships, and not having that over reliance on a few individuals who are the key to a firm, really building out a firm that mitigates that risk and can have an impact on value going forward.
Yeah,
Thank
just
you.
to jump in, I mean, it depends on perspectives, but when there's an unknown or a novel structure, it can cause some unease for some. But I've heard others, expressing that a smart institutional capital provider wants to back that business. I'd prefer to be alongside that than perhaps not. And so, if it's an opportunity to turbocharge that business to accelerate what people are already looking to achieve, if done correctly, then it should even strengthen that alignment between everyone.
Strongly agree with all of that. And I think John's point on technology needs to be underlined. The problem Historically, it's been difficult to get law firms to make long-term investments because, at least in the recent past, some of the partners whose buy-in would be needed weren't 100% sure that they would be still around and, able to realize the benefits of the investment. So to take a dollar out of their pockets now in exchange for the potential return 5 years later, that's tricky to do in a cash economy. Much easier to do in a world of real equity, which is what the MSO structure will hopefully lead us to. But it is increasingly important. Again, I don't think it's an accident that we're seeing substantial investments in technology starting to at least be talked about by law firms. Number one, you're going to need it because clients will insist on it. But number two, you're going to need it as a differentiator. You're going to need it to create a moat, particularly in a world where cash compensation needs to come down a little bit. You're going to need to get away from the star system, to get away from a world in which partners can fly out the door with your key clients. You need to create firm-wide value for those clients to make them stickier clients. And I think that's one of the things that a substantial technology program carefully designed could do. That certainly worked in investment banking and solved exactly the same problem there.
Larry and Dan, if you're not choosing to pursue PE, right? Are the alternatives really, are they a real choice as we look at the industry ahead?
It's very hard to guess as to how this is going to play out. You're really asking, will there be firms that still succeed even if they don't take in outside investment? I think the answer is yes. I think there are niches where you won't have to, or it may not even be possible to. If your firm is in a niche where it makes sense to stay small, it may be difficult to get interest from outside investors because a lot of them have a minimum capital allocation requirement. And you also may not need the money in exactly the same way. I think you'll certainly for the next few years, you're going to see a mix. It won't be monolithic. I think the uptake, the acceptance of outside investment among firms will accelerate quickly. So I think 2 or 3 years from now, it's going to be commonplace. It will have gone from inconceivable to inevitable. But I still do think that new boutiques will pop up in particular areas, particular geographic regions. Some of them will merge into larger firms, which is one strategy that can work. Some of them may grow to the point where they would attract outside investment, but some of them will just stay independent. And I think that's okay. I think there will always be a place for smaller boutiques that are genuinely and completely independent.
Yeah, I agree.
Yes.
I mean, I think it's most likely is a mix. And, for some of the largest, most profitable out there, they may at the moment feel, I mean, investors may ask, why do you need the capital? You have your own capital, and the ability to continually grow organically and invest in programs. But culturally, it does change a gear slightly in terms of a longer term horizon. It does require partners to take that longer term view. If you're making significant investments into technological improvements into the business. But and others may value other things over, they grow to a certain size and happy at that size. So I think I think the safest answer is to say that we're going to see a mix.
I would say that I want to just jump on one thing you said. I think, personal guess, I think within a single digit number of years, it is going to be a huge competitive advantage even for a very large firm to be able to offer real equity. Forget about outside investment, no outside investment, however you structure it. If you can offer real equity and say, as part of your comp package, you're going to get cash. Yes, of course, but you're also going to get, permanent equity in the firm that has a value that's, some multiple of the firm's EBITDA. And, if there's a realization event in the future, you're going to be able to realize it. And even if there isn't, and you're a good leaver, when you roll off into the sunset, you'll get, X times the value of whatever the firm is worth then. However you set this thing up, that is going to be a very powerful incentive to keep the partners you want to keep and to attract the partners you want to attract. I don't know that it's going to be all that easy for a major firm playing in, high stakes, recruiting wars, not to be able to offer permanent equity at that point.
I agree. I think the only thing to add is there's only a certain number of investors in that space, and there's only a certain number of law firms, and so you'll see winners and losers, and you'll see some who are quickly able to take advantage of that.
I agree with that. I think one of the by effects of all of this is going to be increasing consolidation in the sector. I agree with that. We're already seeing it, truthfully.
Thank you. Well, I know that we have covered quite a bit, and I know we have a couple of questions, but before I float over to our Q&A, and just any others or any final comments, thoughts on anything else you might expect to see over the next 3 to 5 years, anything you felt you left unsaid and are just dying to get out. John, we'll start with you.
I think we covered a lot. Obviously the consolidation is I agree with Larry on that. There's going to be, to Dan's point earlier, there's going to be more sophisticated structures and continued entry of capital. I think technology and AI will continue to evolve. The shift towards an enterprise model will take time, but that professional management team, the more formal governance, is that where you're going to start seeing that. And I think, more focus on profitability and data, really trying to figure out where firms make money, how we make money, doubling down into those sectors, not just focusing on top line, really focusing on net profit. And I think one area that, we probably didn't focus too much on today is, will there be regulatory pressure here? And I think that's something to see. What will happen with the non-lawyer ownership? Obviously, fee sharing, is taboo. So I think it's really interesting to see how that's going to develop over the next few years. And obviously, I think Larry mentioned it before. The clients will drive change, right? Clients want efficiency. The market's demanding efficiency. The market's demanding the use of technology. The market is going to be demanding alternate fee arrangements. So as we start seeing that, and we're seeing it in our practice now, asking about what AI is going to do to pricing, I think the firms that align with client expectations, not just with internal economics, will win here, because they're the buyer of our service.
I think that's a critically important point, and you can either lead the parade or get trampled by it. It's going to happen with us or without us. It's already starting to happen. You see in the mid-market M&A space, which is where our corporate practice is really focused. Virtually every client is insisting on a budget and getting quite cranky if you exceed the budget. So the budgets are turning into at least soft caps and almost more like flat fee arrangements. That's where this is all going. It's where it all should go. And the fact that, firms are getting dragged into that world rather than trying to get ahead of it is, I think, a missed opportunity. I totally agree with what John is saying about professionalizing. I always talk about Pascal's wager, where if he wrote that you should act like you believe in God because it might be true, and if there is, there's a payoff, and if there isn't, it's cost free. It's that's sort of how I view professionalizing law firm management, and why we've actually started that process a few years ago. It's making us a better firm, a more profitable firm, a more transparent firm already. And if it ultimately makes it possible for us to enter into the kind of transaction we're talking about today, that's great. But that's how you win Pascal's wager.
Well, that concludes our webinar. I want to thank all of our attendees for joining. I want to thank Larry and Dan and John for presenting, and we will be providing a recording of this to all of you. And And that's it. And thanks to my marketing team and Citrin's marketing team for helping make this possible. So
I want to thank Citrin in particular. This is really, really great. You guys were amazing. So thank you for that. And thank you, Laura.
Thank you, Larry, Laura, and Dan. It was a pleasure collaborating on this.
Right. There's something floating up in the background near John there. But I'm going to thank.
It's
I'm
part
gonna
of
thank
the.
Dan.
It's the confetti from the Knicks parade. It's making its way over here. So
That's beautiful.
thanks all.
That's beautiful. Thanks
Have a
very much.
wonderful day.
Yeah.
Bye.
Thanks, Dan.